I just want to give a little information about who we are as Exchange Resources. We're the largest independent qualified intermediary in the nation. We have offices in San Diego, where our corporate offices, Los Angeles, Orange County, Sacramento, New York, Oregon, Montana, Texas, and we work all over the U.S. We started 25 years ago in 1999, and we have, from that point on, we've been specialized in all sorts of exchanges: delayed, reverse, build-to-suit, simultaneous, and hybrids. We've done over 60,000 successful transactions and $30 billion we've held in exchange funds. And our strengths are that we have fidelity bonds for protection for our clients, E&O insurance, segregated exchange accounts, and we're a debt-free company. So that's just a little about us. Now, just as a disclaimer, I'm not an attorney, and if the client or the CPA, so if a client has questions that they need, we recommend that they do talk to their legal advisors or their CPA or their financial advisors also, so that they can get assistance for them exactly what they need. Thank you. So now we're going to go ahead and get started in regards to how the 1031 works. So to begin with, we have who are we as Exchange Resources. So in a transaction, a qualified intermediary is necessary to facilitate the 1031 exchange per the tax code. We are a qualified intermediary. Maybe some other terms that you hear out in the field would be an accommodator, facilitator. All of that is the same in regards to someone that administers and facilitates the 1031 exchange for our clients. And the qualified intermediary has an essential role in regards to the 1031. A client cannot enter into an exchange without hiring a qualified intermediary to represent them. And also the qualified intermediary is the resource that we would receive and hold the proceeds from the sale in regards to the 1031. And we're going to get into all that detail. But again, just to emphasize that a 1031 exchange cannot be facilitated without using a qualified intermediary. So the question asks, what happens when you sell investment property or highly appreciated real estate? Without a 1031 exchange, you pay a lot of taxes, exactly as what you see here. So as an example of that, we have the first part of the screen here in green, talks about a transaction without a 1031 exchange. There could be up to 60% of the gain could be paid, the client could be paying taxes that represent 60%. So what the example to the right shows someone selling the property for $1.5 million, and they had $1 million of capital gains. So approximately about 400% on 40% of that gain is going to be taxed. So they had $1 million gain. So of the $1 million, the first 400,000 comes off the top for their approximate taxable event, which would leave, because they sold it for 1.5, about 1.1 to reinvest. And that's where they have only about 60% left to reinvest. So now go back to the left again, and we see the green box, the reds, and the pinks. We can see down here that there's several different types of taxes that the investor would pay that adds up to that 40%. There's a Medicare surcharge. So if an investor sells and they're married, they would have any gain after $250,000, they pay taxes on, a separate tax on, which is Medicare surcharge, which is approximately 3.8% for any gain after $250,000. If they're single, any gain after $200,000, they pay that extra 3.8% Medicare surcharge. So that's a separate tax. Then I'm going to go out of order. I'm going to go down to the bottom. we have federal taxes that would need to be paid, which it can go as high as 20%. So we have federal as high as 20%. The next one would be state. State, like for California, if it depending how it's owned, if it's in a corporation or whatnot, it could be as high as 14.4%. So that's always a given, federal and state. If you are owning a property in a state where there's no state tax, then that's good. It's just that they would still have the federal that they would have to pay. Now, the next category of tax is something called depreciation is recapture of the depreciation. And what this is whatever amount has been depreciated on the property since it's been owned as a rental, whatever that depreciation has been taken for the years, then that total amount of depreciation is tallied up and the taxpayer has to pay back 25% of that total. So say you owned a property for 5 years and depreciated and it's $100,000. In 5 years you depreciate it. Then you pay back 25% of that 100,000, which is 25,000. And that's a separate tax. It's not a capital gains tax, it's a recapture. So the recapture of depreciation, and then we talked about the Medicare. So you can see all the different categories of taxation that an investor would pay when it comes to not doing an exchange. The next thing that the slide talks about here is short-term capital gains. So if the taxpayer owned this property for a year or less, then it's not a flat, the federal capital gains tax is not the 20% maximum. It's based on their tax bracket, because that gain would be considered ordinary income, and then whatever tax bracket they're in would be what the federal tax would be. If they own that property for a year plus a year and a day, then it puts it into long-term capital gains, and that's where we get the fixed rate up to 20%. So it can go as low as 0 depending on the income that they have, 15% for most of the population, and 20% for high income earners. Okay, so the state of California has, again, we're talking about someone that does not utilize the 1031. They have a withholding of 3 1/3% of the sales price. So the taxpayer has a choice. They can pay 3 1/3% of the sales price, or they can pay 12.3 of their actual gain, and they have that choice through escrow with the 593. They would click whatever box they want. Now, the withholding would always apply to the sale of investment property unless the taxpayer is doing a 1031 exchange. Then it's waived. They don't have to do the withholding. The taxpayer or the owner of that property, maybe they sold it at a loss, and if there's no gain, then there's no withholding for the state of California. And corporations and some LLCs also are exempt from having to do the withholding. So those are the things that would happen in the event that they sold it and they qualified for anything that we just talked about. Then the withholding would be exempt. Now, when it comes to doing an exchange, sometimes it's not an even exchange and there's money left over. So we call that cash boot. And cash boot, if say you sold for 1.5 and you bought for 1.4 and you had $100,000 left over, then the withholding would happen only on that 100,000, whatever monies were not spent. Okay. The next thing is, if the seller does a carryback, then that is not exchangeable. That's not included in the exchange. So let's say they sold for 1.5 and they carried back a loan for 100K for their buyers. Then that 100K would be separated out, and the withholding would take place on that note, the amount of that note. Okay, so just remember that any cash that comes out or a loan that would be carried back that is not included in exchange and are subjected to withholding. Now, withholding is required if real property is sold without an exchange or if the exchange fails. Okay, so we talked about all the taxes, the withholding, everything that's required if somebody's owned investment property and then sold it without doing it in exchange. So now we're going to talk about the solution. So 1031 exchange is a tax deferral, and the 1031 is a reference to that portion of the tax code. So an exchange is part of the tax code. It's not a loophole. It's can be an amazing gift to an investor. So the question asked here is, what is a 1031 exchange? So a 1031 exchange is a transaction that allows the taxpayer or the investor, I'll use the term taxpayer or investor interchangeably. So it allows them to defer having to pay capital gains tax by buying something else, basically that's equal or greater to what they sold for. So they have a property they're selling. We refer to that as a relinquished property, and they're going to replace that with a new property that they're going to buy. And as long as they do that equal or greater, they'll defer all the capital gains to what they would have paid, what we saw in the previous slide. Now, what IRS requires is that there's two elements. One is that the motive or intent of the taxpayer when they're selling their property and they want to do an exchange is that they're going to, whatever they're going to do, the property that they sold was held as investment property, and that was their motive before they even bought it. They knew that that's how they were going to use that property. And the property they're buying as replacement property, the motive or intent is that they also are going to use this property as investment property. So we have motive or intent, IRS looks at, and then time frame. So if a client, the tax code specifies that they really want to see a 2-year hold, either what you're selling that was investment property for 2 years and they reported it on their tax returns for 2 years, and then what they're buying, they'll hold it for at least 2 years and they're reported on their tax returns for 2 years. But in this scenario, I said there's two points. There's motive and intent, or time and time frame. If they did sell it before 2 years up, then motive or intent would pop up. And if it turns, the client would have to defend their own motive. Nobody else can do that for them. But if they truly held that as investment property, and maybe some hotshot investor came in, offered them a ton of money for this property they bought 1.5 years ago, then really there's no reason why they couldn't sell and exchange and continue finding other investment property to rent out, because that proves their motive was correct, that they were holding it as investment property. So the question is, why are the investors doing that? I'm sorry, just check that. So let's go on to the next slide. They're doing them to defer the payment of capital gains, and that allows them to reinvest 100% of what they got out of the sale of that property to buy more real estate. So 100% of their proceeds they're able to use. So this slide, went back to the original slide we talked about how if they did not do a 1031 exchange, to the left, what the taxes they'll pay. Now to the right shows the opposite. With the 1031 exchange, if they bought equal or greater to what they sold, then they defer all the capital gains event, and they're able to use 100% of those proceeds to buy more real estate. So we can see over here to the right, it says with an exchange, an approximate tax bill would be 0. Available for reinvestment, 1.5, 100%. And of course, that's minus their closing costs. So this shows you the buying power that they have with being able to use all those proceeds to buy more real estate. It's a true advantage. So what does not qualify for a 1031 exchange? So let's check this out. So 1031 exchange, 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 So IRS is very explicit in regards to what qualifies and doesn't. So the first thing, primary residence. The primary residence has its own tax shelter called the 121. And we're going to talk about something later that does allow a person to use an exchange with their primary. We'll be talking about that in just a few minutes. But general primary residence does not qualify. A second home. If that second home was truly used for the enjoyment of the family as a second home, so they had a cabin in Big Bear, they let family use it, they used it, that does not qualify. A second home, first of all, doesn't qualify at all for 1031. When they sell it, basically they're going to pay the tax. The next thing that does not qualify are people that buy properties for the sake of flipping. So dealers and flippers, they do not qualify to utilize the 1031 exchange. IRS looks at them as the houses they're buying as inventory, it's a business, and they're going to pay taxes. They're not holding it for the 2-year hold, and it's not being used as a rental. Next thing is stocks and bonds and REITs. Those are not real estate. So as far as IRS is concerned, those we cannot do 1031 exchanges out of the sale of a piece of real estate that was used as a rental property and buying stocks and bonds or going into a particular REIT. The evidence of ownership is a stock certificate, not a deed representing real estate. So it does not qualify. The only thing that qualifies is real estate for real estate. Now, some people are selling their partnership interest in a property that they may own or a business that they may have. That does not qualify either. And mortgages and promissory notes and solar carrybacks do not qualify. Okay. So now we talked about the primary residence. So we're going to go out of the investment world for just a moment. And I'm just going to talk about the 121 ruling in regards to the primary residence so that we can get this out of the way. And there's another slide that shows there is a time where someone can do a 1031 on their primary, and we'll talk about that in a moment. So to begin with, the 121 universal exclusion is for the primary residence. It allows the taxpayer, if they're single, to exclude up to the first $250,000 of gain. And if they're married, they can exclude up to $500,000 of gain. But the rules are the property must be owned and used as a primary for at least 2 years, minimally, or 2 out of the last 5 years. And this doesn't mean it needs to be concurrent or consecutive. So what I mean is in the last, say, 5 years, maybe the first year 1 and 5 years is today, current. So year 1, you've lived in it, you rented it out year 2, year 3, you moved back into it, and you sold it in year 4. So in the last 5 years, you have 2 years, 24 months that you actually lived in that property. So because of that, you still qualify to utilize the exclusion for whatever their circumstances, married or single. So any amount that's over that exclusionary amount, then it would be subject to capital gains. So if I'm being married, I sell the property, I have $600,000 gain. The first 500 would be protected tax-free under the exclusion of the 121. And the last 100, I would pay taxes on. Okay, so the question here is, what about a vacation home? So a vacation home is different than in this, or what I'm going to talk about is different than a second home. And the thing that makes it different is this criteria. The property, if you have a rental property and you've owned it as an investment property for at least 2 years, then that qualifies as that'll qualify for a 1031. And the property, as far as IRS is concerned, has to be rented out minimally at fair market value for at least 14 days each calendar year. So it does not have to be rented out 24 or all 12 months in a year. IRS allows for like Airbnb and vacation rentals. They understand some things are rented just for the season. Other times, maybe rented out 6 months a year or whatnot. So that's okay, because minimally it has to be rented out at least 14 days a year. But what's not okay is personal use. So the last bullet point there brings out that the property has not been used, as long as the property is not used for personal use more than 14 days a year, or 10% of the time rented, it will qualify as investment. So if you have the property like an Arrowhead or Big Bear, and maybe every year at the end of the year, Christmas time, you use it with the family for 2 weeks, then that does not hurt the use, that doesn't change that it qualifies as investment property. Then, and maybe it only was rented out 3 months, but you use it 2 weeks a year at the end of the year, that would still be classified as investment. But if you go beyond this formula, 2 weeks, 14 days, or 10% of the time rented, then it would be classified as a second home and would not qualify for a 1031. And this 10% of the time rented is, let's just say I rented it out for 300 days. Then I could use it for 30 days and it still would not, it would still be classified as investment property. So what the IRS gives you, whatever's greater, the 10% time rented or the 2 weeks, the 14 days. So that shows you that Airbnbs do qualify as vacation rentals, and that was the revenue procedure that came out in 2008. Okay, so the next question is, can I convert a rental property that I acquired through a 1031 exchange to my primary residence? So right off the top, yes, it is possible. But let me tell you, the rules need to be followed exactly. Because IRS will, especially the state of California, they'll disallow it. So let's talk about what those rules are. The first bullet point says that it's permitted to change the character of a property from investment to primary. But what's so important is the intent. When they bought the property initially, the intent was to hold it as investment property, and that they rented it out for 2 years before that conversion is made. Absolutely necessary. They have to rent that property out for 2 years before any conversion. Now, the second bullet point here says investment properties acquired in the 1031 exchange and sold as a primary residence. So some people they want to do this, they want to convert it to the primary because they think they can get that 500,000 or 250 exclusion. Let me tell you that that has changed since 2009, and not all gain would be qualified for that exclusion. So what happens is the gain is allocated according to use, and the years that it was a rental, that gain you pay taxes on, and the years that you live there as a primary, those years would be used towards that exclusion. So how they do it is they take the gain. So let's say there's the gain of $1 million, or let's go with 5 years, 500,000, and they owned it for 5 years. This tax person will divide the gain into years owned. So in my scenario, or my example, it would be 100K a year. So the first 2 years it was rented out. So that's 200,000. That 200,000 is paid. You have to pay taxes on it because it doesn't qualify for the primary residence exclusion. But the last 300,000 was rented out. Then, oh, excuse me, I'm doing this backwards. Let's say the last 3 years. Oh no, that's right. The last 3 years you move into it, and that's 300K. So that's covered under the primary residence exclusion. So if you're married, it's all 300K, you get tax-free. If you're single, you only get up to 250, and you're going to pay taxes on the last 50K. So it does work. The longer you own it, the more watered down that proration works in your favor. But it's not what it used to be, where people just lived in it and the past gain would be gone. They can get all the 500. The tax code changed in 2009. Okay. So now, this is what I was talking about earlier. let me make sure there's no questions. Okay, so we have from Beatrice, can a foreign investor take advantage of the 1031 exchange? If yes, what's the process to get started? This particular investor does have a Social Security, but they do have a 10. Since they do have a 10 and a Social Security number, Beatrice, they can qualify for a 1031 exchange and it'd be no different than anybody else doing an exchange. So the process to get started, we're going to talk about that in just a few minutes in the slide presentation. But the answer to your question is they absolutely can utilize the 1031 exchange. Okay, the next one says after 2-year holding period, can the investor sell it without the 1031 exchange? What happens to capital gains and the other taxes? The answer to that question is if we did a 1031 exchange, bought a property, held it for 2 years, and now you want to sell it, you totally can, but now they're going to pay the capital gains tax from the past, what was deferred when they did the first exchange, and the current gain. So they get put the past gain and current gain, they put together, and now they're going to pay taxes on everything. Because the exchange originally is just a deferral. So you're just deferring the taxes to a time where you may not, where either you're going to sell and not do an exchange, so you'll pay the taxes then, or yeah, so you'll pay the taxes then, or do an exchange and defer and continue on. So the last question, I hope that answers that. The last question is vacant land qualified for 1031 exchange? Absolutely. IRS has put vacant land into its category all of its own, and it does qualify even though there's no income on it. It does qualify because from IRS's perspective, it's not used for personal use. This personal use is what we disqualify. So land definitely qualifies it. So if you sell land, you can sell that to buy anything else you want that's real estate anywhere in the US. And the last question, if I'm for a vacation home, if I'm the owner, can I rent it like I will actually pay for the rent so that I will not show that I use it personally without paying? No, they do not. Even if you rent it you're renting from yourself, that doesn't qualify because you're using, you have personal use of that property. IRS looks at it just clear and simple, personal use. So that's not a way around it. The only way around that, 14 days or 10% of the time rented on a vacation home, is you can use the property if you're going there to improve it, repair it between tenants or whatever, and say you're going to stay there while the work is being done. As long as you have invoices to show that the work was done during the time you were there, then you can be at that property and that would not be considered personal use. Okay. I hope that answers your questions. Go ahead and let me know. Let's see. Just working that we can keep on top of the question. Okay, so now, remember what I talked about a little earlier about there is a provision that you can combine the 121 with the 1031. So the primary residence, there is a situation that you can do a 1031 exchange. So let me explain how that works. Say someone has a property that they've owned for a long time, and the taxable event would be huge if they sold it. So for example, maybe they bought it for 400,000, now they're selling it for 2 million. So their gain is huge. So this slide is the beginning of this explanation of combining the 121 with the 1031. And this is a revenue procedure that was released in 2005. So what it says is the taxpayer can sell the investment property that has previously been used and reported as a primary, but take advantage of both tax shelters. And this is how. They, first of all, show that they've lived in that property 2 of the last 5 years, so they qualify for the primary residence exclusion. And people that do this have usually lived in that property for at least 20 or 30 years. But minimally, they have to at least be in the property 2 of the last 5. And then, so say they've owned the property for 30 years and they have this huge gain. Then the next bullet point says at the time of sale and reported as investment property, then they can utilize both tax shelters. So what that means in English is that they've owned the property for 30 years, they moved out. So let's say they've moved out in year 28, they rented out for year 29 and year 30. So the last 2 years were rented out. So now, and what's happening is in the last 5 years now, they still have primary use years, and then years 29 and 30, they rent it out. And if they sell it before the 5th year is up, and that's crucial, they have to sell this before the 5th year is up, then they can take advantage of both tax shelters. The 121, where they get their tax-free money for whatever exclusionary amount they qualify for, and the 1031. So let me show you a great example. Taxpayer bought the primary residence years ago. So let's say that 30 years ago for $300K and now selling for $2 million. So now their gain is approximately 1.7. The taxpayer is allowed to use the 121 universal exclusion because in the last 5 years, they had first their primary residence use. Remember, like they rented it out in year 29, 30. So they lived there for 30 years. So they, in the last 5 years, they have 2 years of primary, 2 years of rental, and this is what happens. IRS allows them to combine the 121 universal exclusion with the 1031, and the formula goes like this. They sell it for $2 million. The exclusion is $500 if they're married. So they get that money right off the top, tax-free. Escrow will release that money to them. And now for the 1031 exchange, they can, now the money that's left over, the 1.5, if they do a 1031 exchange on that, they'll defer the remainder of that taxable event, and they're able to buy investment property. And so now they got their tax-free money, their $500K, and the rest of the money they were able to buy investment property without buying what they can with what was left over if they had to pay the tax. Hope that makes sense. So, as you see in the red, it says taxpayer must buy equal or greater in value to defer 100% of the capital gains and should seek the advice of their accountant to ensure that they can receive the tax benefits that they hope for. Okay. So now that we're going to end the world on, our world on primary residence. And now we're going to talk about something else that we hear, I think we've been hearing a lot about. I hear it a lot going on, is a type of real estate that investors may be buying into called the Delaware Statutory Trust, or the acronym is DST. And this is a type of investment for certain taxpayers that works for them. And a lot of times it's the people that are tired. They've been landlords for 30 plus years. They want their investment property to keep working for them, but they don't want to manage anymore. So the Delaware Statutory Trust can be a great tool. So what this is it's an investment that allows a smaller investor to buy into a larger securitized institutional grade property with the advantage of a 1031. So what they do is they buy a certain percent, whatever they are bringing to the table. If they sold for $2 million and they want to buy a DST with all that money, then whatever percent of that property they're buying into that equals $2 million, they can have that beneficial interest of that. Then the next bullet point says that it's treated as real estate, thus satisfying the requirement of the revenue procedure that was brought out in 2004, allowing investors to buy DSTs. And the beneficiaries of the trust have, so the investor buying in, they don't have to worry about the day-to-day managing of the property. They have, property managers, commercial managers and stuff to take care of it. But they also have people that do these DSTs, the companies that they work with, They have requirements, net worth requirements that must be met. So, and like I said, it may or may not be for everybody, but for certain people, it could be the perfect answer. And the benefits are, for the right people, is that you can have diversification. So say you have money left over, 500K, and you bought something, you sold for 2 million, you bought something for 1.5, you still have 500K left over. That leftover money you can use to buy a percentage of a DST. Or you can diversify, the different types of properties you own, like multifamily, warehouses, retail offices, office space, oil and gas royalties. It gives you a chance to have maybe a little piece of this pie, that pie, or whatnot, so that you can diversify your portfolio. The next thing a DST, as far as the benefit, is it's passive income. It's a passive investment. It's managed professionally. Some have monthly distributions, payouts. You have the appreciation, the tax benefits from depreciation, non-recourse loans. So there's a lot that can be a great benefit for an investor. And like I said, it may not be for everybody, but we're hearing a lot about them. So I wanted to at least give you a little introduction to what they're about if you haven't heard about them. Now there are risks. They're not liquid. So, when you buy in to one of these types of properties, there's typically a hold. So the property is usually held 5 to 7 years by the sponsor. And at that point, they may determine to sell. Then you, at that point, can take your percentage and either go into another DST or combination of DSTs, or go back to traditional real estate. So, but that's the risk, that there is a typical held period. Also, that you want to make sure that the sponsor that you work with in regards to DST has a good track record, and that they're able to manage the asset perfectly, and that you don't have the ability to go in and refinance like you would if you had your own property. So those are some of the, the benefits and risks of the DSTs. So, working with investors. Okay, so with working with investors, this is something that is of real value for an investor, because an investor would, by doing the 1031 exchange, we talked about that an exchange allows them to defer all the capital gains event. But that's not the benefit. Okay, we can defer the taxes, but what can we accomplish by deferring those taxes? And this list here shows that you can accumulate your wealth. I had an example of someone that I did an exchange for years back. When I met him, he owned 60 properties, and he acquired them. He started in the 70s, buying things, holding them, and then as they appreciated, he'd sell one property and buy two. And through the years, he'd sell one and buy three, maybe. And he just kept doing that through the years. And he started off with like 2 properties that he bought. So after about 25 years of owning this, starting off with 2 properties, he sold, exchanged. Like I said, never exchanged 1 for 1. He did 1 for 2, and sometimes 1 for 3. And so at the end, he really accumulated his wealth. He had 60 houses. His biggest problem in life at that point was he wanted to retire, and he didn't know how to do it. So he was able to do a 1031 exchange, it took time, but he sold most of his properties, so he didn't have to manage them anymore. And he bought DSTs, and he was able to be, management free, and he did very well. So that's just an example of what somebody can do and how an exchange can help accumulate wealth. It can improve cash and equity return on the property. If you have a property that's not performing, then you don't have to hold it because you're afraid that you have to pay capital gains tax. You can do an exchange, improve, upgrade, and get properties that really do perform for you. You can also add to your depreciation schedule. You can diversify or consolidate. Some people want to take one high value property and buy lots of smaller value properties, or vice versa. Take all their smaller value properties and buy one great larger asset. So, and the other thing is you can change the type of investment that you have. Like the question we had earlier, can land qualify? maybe somebody now, after owning land for quite a while, they want to sell that land because it grew in value, it appreciated beautifully, so that they can make an income. So they want to change the type of investment, or they have retail and they want out of retail and they want to go to apartments. So they have apartments and they want to just go to single family. So that allows them, and the 1031 exchange allows one to make those changes. The other thing is people move. So you move from California to New York, and after you're all settled, the kids are in school and the dust is settled, now you're looking at your investment property thinking, I don't want to manage across the United States. So I want to sell that and buy something in New York. So people, a 1031 exchange allows them to do that without being stuck with the taxable event. And one of my favorite things is the estate planning. People use the 1031 exchange to as a planning tool for their estate. And I have a quick little example. Let me make sure I have time. A quick little example of how that works. I had a client that came to me a few years back before COVID, and she was like 94, and she had 3 apartment complexes in Buena Park on the same street, and they were just one complex after another in the end of a cul-de-sac. So she had 3 grown kids. So she wanted to have ultimate goal. She wanted each of these kids, her grown kids, were going to get one of these apartment complexes. So what she did is she sold one at a time and told kid A, I'm going to sell this property that I have and do a 1031 exchange. I'm the seller and I'm going to be the buyer, but I want you to pick out what you're going to inherit, what you can manage, what you want to take care of, and what what you're willing to work with. So they did that. They sold. The kid A picked out different properties that worked for them, did their exchange fine. Now we went on to kid 2, kid 3. They did the same thing. So in the end, they changed the family trust, showing that each of these kids, kid A, B, and C, A, B, and C, that they would inherit the properties that were exchanged into the ones that they picked. And this woman, this investor, was amazing because in her 90s, she used this tool as a beautiful estate planning tool. And the sad part, it took about 1.5 years of going through all of this. I got to work with the family and with her. But about 6 months after they were totally done, that client died. And it was really sad for me because I ended up loving this woman. But I never seen a settlement of an estate taking place so nicely. Because what happened is everybody chose what they were going to inherit. It was in the family trust, so there's no arguing, no bickering. Everybody got what they wanted. So that was a live example for me, like a living example of what a great estate planning tool a 1031 exchange could be. Okay, I'm gonna. Okay, so I'm sorry. There's a few slides in here I had blocked out, but by the time we set it up, I used the wrong PowerPoint presentation, the one that I didn't block out. So please forgive me. For time, some of that is covered in our advanced class. Okay, so now we talked about the benefits of the 1031 exchange for the taxpayer. So what about for the real estate professional that represents the taxpayer? There's some beautiful benefits for them too, because it could really increase their business. So in Orange County alone, there's over 149,000 absentee owners. And of these absentee owners, there's about 17,000 plus that live out of state, and 14,000 plus own 2 to 4 units, own two to 4 units. So how can you be part of that? So this slide has a lot of information here. It talks about how you can increase your business drastically with the 1031. So what you want to do is ask your title rep for a list of non-owner occupied properties in 2 to 4 units. So these lists could be, like the PowerPoint shows, could be a great opportunity to get more listings. So what you're looking for is people that hold properties for 15 years plus. because they may have dormant equity that can be reinvested. It's just sitting in this property. They can take that equity and buy more property and have that money work for them to increase their income. So sometimes to get a better return on their equity, they need to maybe sell what they have and buy something larger or something that's better. And when you do buy something of greater value, you can add to your depreciation schedule, which is another write-off. So that really helps. And then when the depreciation benefits run out, they can benefit from they can get this depreciation schedule going again for the difference of what is greater. And that can give them the write-off that they lost when the depreciation schedule is done. So that helps them. It helps you as a real estate professional can help your clients or potential clients to help them to increase their wealth. So that's a beautiful thing. Also, it says little or no debt. When you get these reports from your title rep, maybe you can ask for a list of non-owner occupiers with no debt, because then that gives them the ability to leverage everything they have to buy more property. So they're able to maybe get a better return. They're able to either diversify and take that money and buy more properties, or consolidate, take that money and buy and sell several properties to buy one big one. And out-of-state owners, you could really be of a benefit to them. And this is what can increase your business, because maybe it's too hard for them to manage living out of state. They have a property in Southern California, maybe they live in Kentucky or Carolinas, and it's just too hard. They thought maybe it wouldn't be too bad, but it's hard. So you're able to help them maybe sell and buy property closer to them so that they can manage that property closer to home. Okay, let me check the Q&As. Can a rental property be exchanged to buy two properties? Can a rental property be exchanged to buy one lower price property and pay partial tax on remaining balance of exchange amount? So to answer Steve Lee, the answer to your question, first of all, is absolutely you can sell one rental property and buy two. So let's say I sold one for $2 million. I bought one for 1.5, and then I still have 500,000 left. So I bought a little condo somewhere for that 500. So now I have two properties, and I bought equal or maybe a little greater than what I sold for. And it's the cumulative value of all the properties I buy that add up to that equal or greater. So absolutely, you can do that. And a rental property can be exchanged to buy one lower price property. So say they sold for $2 million and they buy them for 1.8. So they're short $200K in my example. So absolutely, they'll have a great exchange. They're just going to pay taxes on that difference. And it may be the perfect thing for them, a little tax, but they benefit with being able to defer the greater amount of taxable event. Okay, let's go to Martin Lee. If the property has been owned for 30 years and the property was leased out at the year 29 and 30, can the owner sell the property right after the 30th year and enjoy? Yes, just listen, absolutely. Oh wait, Margaret, I'm sorry, I jumped straight to you. I thought I was talking about reading Martin Lee's, but let's jump to Margaret and then we'll go back to Martin. So the property, exactly. So they owned it for 30 years. They leased out year 29, 30. Then when they sell it, as long as in the last 5 years, so this is 28, 20, 27, 28, for they lived in it, 29, 30, they rented it. As long as they sell it before the 5th year is up, then they qualify for both tax shelters, 121 and the 1031. The crucial element there is they have to have both uses in the last 5 years and sold before the 5th year is up. I hope that works. And let's go back to Martin. My client sells one primary residence and one investment out of state. You want to buy a home in OC and will use it as a primary residence. Can they do 1031 from their sole investment? But unfortunately, Martin, no, they can't. Because if they sell an investment property and use that money to buy a primary that they're going to live in, that would not qualify for a 1031. I hope that answers everybody's questions. Okay, so let's go to the next slide. So us with that Exchange Resources, myself and Frank, we have tools to help you so that you can grow your business. And we're glad to help with you and your clients so that they can work their way through this 1031 process because it can be difficult. So we provide, if you're looking for new business, maybe with the non-owner, like out-of-state owners and whatnot, we have letters that we can provide for you. We have marketing material. We also are happy to help you. So like on a listing appointment, you're there on the listing appointment and they bring up something about 1031, or you realize that maybe this property would be qualified for a 1031, then we are happy to do conference calls with you and your client, have one-on-one agent and client consultations with either in person or on Zoom, whatever works for the client, so that your client can have accurate information to make educated choices. And that's real important to us. We also teach a ton of classes in real estate offices. We offer investor seminars for, to reach out to investors to help educate them how they can benefit from a 1031. And we have on-call support. We've got a lot of transactional guidance if a client is going to work with us, we'll follow through and help with them from the beginning to the end with hand-holding and making sure they understand the process. So we're all about helping you so that you can help your business grow, which helps your clients make good decisions and utilize 1031 exchange so that they can benefit themselves. Okay. I have a client thinking of selling, I'm going to ask this question, thinking of selling their units and putting all into a REIT. They're out-of-state owners and in their mid-70s, they're just tired of being landlords. A REIT, unfortunately, does not qualify as a replacement property for 1031 because it's basically a stock transaction. The way around doing that would be doing a DST. So if they're tired and tired of being landlords, but they still want their money to work for themselves, it matters what their goals are. If they want their money to still work for themselves, then a DST may be the beautiful answer, or maybe do a partial exchange and have some money that they pay taxes on and some money they invest in a DST. If they just are done, then it's better just to sell and pay the tax. So I hope that answers the question. Thank you. You're welcome. And then the last question for the moment is, can all the improvements to a home be deducted from the profit? Example, purchase 400K, put 250 in the improvements, sold it for $1 million, profit is 6K, can you deduct the 250 improvements? For the 1031 exchange, no. So if they purchased for 400K, that's their improvements, and they sold for $1 million. We don't, for the 1031 exchange, we're not going to deduct out the 250 in improvements. They got to buy equal or greater to the $1 million. But if they buy for less, then what happens is their tax person, this is where their tax person comes in, because the tax person will apply the money that was spent for improvements at 250 to their basis and adjust it. So now the taxes they pay will be less because of the improvements that are made. So on our side for the 1031, we don't deduct the improvements. They have to still buy equal or greater to what they sold for, but their tax person, this is where it's real important for them. If they want to buy less and they have a lot of improvements, then they need to talk to the tax person so they can get a good idea how much less they can buy, where those improvements can really offset that gain. I hope that helped. You're welcome. Okay. Here we go. Sorry. Okay. So. I've got technical difficulties here. I'm going back. Okay, two things that I want to talk about real quick on this slide before we move on. When you're working with a client and you're going on a listing appointment, there are a few things that really are important to sort of sort out on that appointment so that you can help your client figure out the best route for them. And like the slide says, you'll shine as a real estate professional and you'll save your client a lot of money. So these are some things you want to ask. What was the like they're selling this property? What was the use of the property? Was it a primary, second home, or rental? Because sometimes we get people, an agent will say, call Deb or call Frank. And, you know, I'm sure this qualifies for a 1031. We find out that it was a vacation home that they used. It doesn't qualify. So it's important to find out how the property was used so we can make sure that it qualifies or not up front. When the property was acquired, what kind of capital gains are we looking at? What's the potential liability? So what did they buy the property for? And if they're not talking about doing the 1031 exchange, if it's investment property, have them talk to their tax professional. Give them that as a homework assignment. Because I have to say, I've been with Exchange Resources for 25 years. And in the 25 years, it's been chock full of clients that call me. They sold a property. They didn't want to buy more investment property. They were tired investors, and they felt like, how bad could the taxes be? Basically was their reasoning. So now they sell, it's tax time, and they got their tax bill. And I actually have had so many grown men crying their eyes out, begging me to help. And now they've sold, closed escrow. It's been 6 months or 4 months or 6 months later, and they want to see how they can get out of it. And it's too late. So what's real important is for them, if you have an investor that owns investment property that wants to work with you to list that property, and they say, I don't want to do an exchange, I'm burned out, don't believe them. Make them talk to their tax professional before that property gets in escrow so that they can make an educated decision. If they can live with that amount that their tax professional tells them, okay, if you don't do an exchange, you're going to pay this much in taxes. If they can live with that, then that's a win. But if they can't win with that, then that's a win too, because now you just help them, you save them from themselves. So now they have an option of doing the 1031, and maybe now the 1031 has value to them. And maybe they're tired of being a landlord. So maybe now that may be a person where a DST would be really a positive thing for them. So you know, it's very important to ask that question. The next thing is, how is the property owned? Who are the owners of the property? So is it just a husband and wife and that's it? Is it owned individually? Is it owned in a trust? Is it in an LLC? If it's in an LLC, who are the members of the LLC? Is it just the husband and wife and that's it? Or are there other members? If there are other members, what's important to understand, and we covered this in our advanced class, so I'm not going to go too deep into this, but the basics are, it's the LLC that's the owner of the property, not the individual members. So say we have 4 people that are part of this LLC, and they all have 25% ownership. They're members of the LLC by 25%, so equal shares. So some people think in their heads, since they have this, you know, this 25% shares of this LLC, that when they sell the property, they can take their 25% and buy whatever they want to buy, and they're only responsible for that taxable event for that value of that 25%. The reality is that's not accurate. If there's 4 people that are members of that LLC, the LLC is the owner, the LLC would be the exchanger, the LLC will sell, and the LLC will buy. If everybody wants to separate out, you can't do it at the last minute. So you go like 2 tax returns before, tax years earlier, and you can deed it out, drop it out of the LLC, put it into tenants in common, and then rent it out for 2 more years and season it. Now everybody can sell and then take their percentage of ownership to buy whatever they want. But it's not a quick fix. You have to start 2 years before you sell it. Or maybe you sell it as the LLC is the owner, the LLC is the seller, the LLC is the buyer. So the LLC may buy property, but now it has to be held for 2 years before it can be separated out. So it's a process, and I advise if anybody wants separating out, they need to talk to their tax professionals. There's a discussion that goes to this that we don't have time for this class today, that this is covered in our advanced class. But it's very important that we can talk to them and structure it for them, but they need to talk to their tax professional or their attorney, their financial planner, so that they can structure something in the future for how to separate this all out. I hope that makes sense. Okay, I see a question. Is there any questions to that? Yes, we're going to release the PowerPoint to everybody. And there is a recorded session available too. Okay, so let's go back. Okay, so those are the real important questions. So if it's owned in an LLC, who are the members? If the client says they don't want to do an exchange, make them talk to their tax person, give them the estimated cost, the sales price of the property, and then the fees involved with selling, so that they can talk to the tax person and get a good idea what the taxable event would be. And it's important to find out how that property was used. So those are important questions on the listing appointment that you can really help your client with. Okay, so now we're going to talk about 1031 exchange. Now we're going to talk about the rules and everything that's involved with how to do a successful exchange. So we're going to start out with the different types of exchanges that are incorporated in the 1031. So we have the first is the most popular of all exchanges that we do. It's called the delayed, or sometimes you hear it referred to as a forward exchange. And what that means is they sell first and then buy. So they're selling and then buying. We're going to talk about that in great detail. The next one is reverse exchange, where they buy first and then sell. So we'll talk a little bit about that. There's a build-to-suit exchange, where they buy and they can use their proceeds to improve the property. A simultaneous exchange is when everything closes at the same time, the sale and the purchase. And then there's something called a hybrid. Okay, so let's go on. Let's get started talking about the delayed exchange. First one. Okay, there we go. The delayed exchange. So like I said, this is the most common exchange. The 1031 is also known as the forward exchange. And this is the person that really brought the exchange to the fore is a gentleman by the name of Mr. Starker. And as a result of his own personal court case for a property that he bought in 1979, the ruling allowed for a time frame. Before this happened in 79, all exchanges were simultaneous, where the sale and the purchase had to close together. So with the result of Mr. Starker, because he sold a paper mill company or land, he sold land, and it was sold for so much that he took his monies and bought a whole bunch of single individual properties. But it took him like, I don't know, 5 years to accomplish this exchange, because there's no ruling yet. He studied the tax code, he mapped out a plan, and he did a great job. So IRS audited him, and they did allow him to proceed forward, but they set up from that point on, IRS went back and made a ruling where there's a time frame, and it would, instead of 5 years, they have a total of 180 days. So we're going to talk about this. So they have this is how the time frame started. It started back in 1979. Like I said, we have a simultaneous, which they buy and sell concurrently. The one thing I want to say in regards to this is some people feel that because they don't have any control of those proceeds, it's closed, and the sale and the purchase closed on sale same day, they feel like they didn't have any control of the proceeds. There's no need to work with a qualified intermediary. Well, that's not the case. IRS requires, even if they don't receive any proceeds or have no control of the cash. IRS still requires that they work through a qualified intermediary because they have what IRS refers to as constructive receipt of those funds. And they do have control of where those funds go. So by using a qualified intermediary, takes the taxpayer out of the picture and allows the qualified intermediary to be the person that gives the instruction to escrow as to how to proceed with this deal. And the monies go from the sale, from the proceeds of the sale directly to the proceeds of the purchase. So a qualified intermediary is really essential for the success of that transaction. And then there's the reverse. I'm not going to go into a lot of detail in regards to this because it's covered in our advanced class. But basically, the core of this is that it allows the taxpayer to buy first and sell later. And it could be a great tool because somebody may, for a couple reasons. One, somebody may come across the perfect replacement property ever, and they know this would work for them, and this is something that they really want. But they haven't even begun selling, and they have their own resources, so they're able to buy. And that's where the reverse is beautiful, because if they buy under the structure of this reverse, then at the close of, and I'll go into some of the markers here, but at the close of the purchase, basically, they have 180 days to sell what they have to sell. And then those proceeds are used to reimburse them back, pay them back for whatever monies are out of pocket for that acquisition. But it's much more complicated than how I'm spelling it out right now, because the reverse is one of the most complicated exchanges in the code. To do this successfully, we create a corporation, and that corporation is called, from IRS's perspective, an exchange accommodation title holder, or the acronym is EAT, E-A-T. And one of these properties, whatever they're selling or buying, it's parked in that EAT. And now it allows them to proceed with an exchange, because if you bought, you closed escrow, you own it. You sell, you own it. You can't do an exchange on property you own. So it disqualifies it. So this corporation that we create and parking in this EAT circumvents that issue. They don't own both properties at the same time. It allows them to proceed with their exchange. So that's just a real quick synopsis of that. But like I said, in our advanced class, we'll go into great detail. And just last thing here I wanted to bring out is the bill of suit, which allows the taxpayer to use whatever, like they can buy for less. And they can buy for less. So say they sell for 1.5, they buy for 1.3, they have 200,000 left. They can use that 200,000 to improve the property that they're buying. So again, it's a very complicated process. We have a corporation that we create. The purchase property gets deeded to that corporation at closing. So now they don't, so because if we just closed and had money left over in their account without this deeding process, they would pay taxes on the money left over. But now this money's left, and they can use that money for the improvements. We pay the tax, we pay the contractor, the vendors. We're very, with those proceeds that are left over. And it really, really works if we're dealing with an all cash transaction. So again, this will be covered more in our advanced class, but I just wanted to introduce the concept. Okay, let's see here. So now, 4 basic rules for the 1031 that we're going to talk about. These are, I think this is safe to say that this is the perfect backbone to the exchange. So first of all, we want like-kind property. So that can be confusing. So some people think that like-kind means if I'm selling land, I have to buy land because it's like-kind. Or an apartment complex, four units, I gotta buy 4 units because that's like-kind. But that's not what like-kind is according to the tax code. The tax code shows us that like-kind has nothing to do with what type of property it is and everything to do with how it's used. So like-kind is investment property for investment property. And the tax code actually says, it specifies it's investment property or property used for the productive use of a trade or a business. So I could sell my fourplex and buy a building that I use for my business, because that's a productive use of a trade or a business. I can exchange it into property that my business will occupy, and that totally qualifies. Or I can sell my fourplex and buy, you know, three single family residences or whatever I want to do. So like kind is investment for investment. So that's one of the basics. Number two basic rule is that to defer all the capital gains event, as we spoke about already, they need to buy equal or greater than what they sold for. So if I sold for $2 million, I can deduct the cost of sale, the non-reoccurring closing costs, which would include commission, escrow, title, recording fees, documentary transfer fees, the one-time fees related to the sale. So I can deduct that. And so if I sold for 2 million, let's just make the number up. I'm not trying to be logical. Let's just say it was 100K. So now we're down to 1.9. As long as they bought, our investor bought equal or greater to that 1.9, then they would defer 100% that taxable event. So, and they can do this, as we talked about earlier, by answering one of the questions. They can totally buy one property, or maybe split it up into two, or whatever they can do. So it's the cumulative value of what they're buying that adds up to that equal or greater. Now, the next basic point is the third point, is we have a timeline that IRS requires, that they have to stick to this timeline, and if not, then the whole exchange would be disqualified. So let's talk about that. From the close of escrow, they have a total of 180 days to buy, sell, and be done. Okay, so they get a total of 180. But the first 45 days of that 180 is separated out for the sake of creating a different timeline, and that's their identification period. And they have 45 days to actually identify what they're going to buy, and this identification is done in writing. So what's important to understand is whatever's identified by the time that 45th day has passed, say now we're day 50 or 60, something happened, and the properties that were identified on that 45-day in that 45-day window, something happened and they can't buy it, they can't acquire it, then the exchange, if they can't buy what they identified, their exchange is disqualified. So it's very essential that they buy, but whatever they identify, they don't quickly identify. They make sure, like, well, we'll talk about strategy in a minute, but whatever they identify, they're able to close on. So what is some strategies to that? So maybe, and I'm not saying it has to be, I'm just saying maybe, you can get a little longer escrow period. So instead of going 30 days, maybe a 45-day escrow. Or instead of 45, maybe 60 days. Just eke a little bit of time and get the inspections done for the buyer, have the inspections done, so that you know that this property's, everything's okay. And be out there then looking for your replacement property before escrow even closes. You got a little window there that you got a few days, even if you got 30 more days, or 45 more days. That gives you a nice window to be out there looking, presenting offers. You can present an offer and have an offer accepted before your escrow closes. That way, maybe you can even close inside the 45 days and have a perfect exchange because you closed before the identification period was up. So that's just real important to pay attention to that time frame. And the last basic that's real important is the taxpayer, whoever owns the property on the property being sold, must be the same party to buy the property that's being purchased in the exchange. So we need to have the same taxpayer. So the same taxpayer would be either, like, if it's a corporation, I mean an LLC, something like that, then we have a tax ID number. If it's a husband and a wife, we want to make sure whoever is the seller needs to be the buyer. So those are the four basics. We want like kind, investment for investment, by equal or greater to what they sold for, to defer 100% of the taxable event. The time frame, got 45 days and a total of 180 to buy, close, and be done, with the first 45 days to identify what will be closed on, and that the same taxpayer that sells, it must be the same taxpayer that buys. Okay, there's a question, so let me just double check that. When do you start counting the 45 days? This close of escrow is day 0, and the next day is day 1 of that clock. Okay. Okay, so we're talking about a little bit more about what we just talked about with the like kind. We have a rental condo. So we have a rental condo for a fourplex, commercial building for ranch land, vacant land for residential, real property for an easement, the Delaware Statutory Trust that we talked about, the DST, to be a perfect replacement property, and any leasehold interest in real estate that's 30 years plus with 30 years plus qualifies as real estate. So that's real important. So this shows us that like kind, again, has nothing to do with what it is and everything to do with how it's used. What's essential here down on the bottom is it says domestic for domestic and foreign for foreign. So you can't sell property in the United States and buy in Mexico or buy in Costa Rica. It's U.S. property for U.S. property and foreign for foreign. Very important. Now, we talked about buying equal or greater, but let's talk about, let's see that example in live here, on the screen. So that we sold for 1.2 million. The non-recurring closing costs came up to about 100K. And you see below, this is commission, escrow, title fees, transfer fees, recording fees, exchange fees, inspection fees, any type of contractual agreement between seller and buyer for repair or credit. Those are what qualifies as the non-recurring closing costs that get deducted out of the 100K. What does not qualify is a loan that's paid off. That loan debt does not disappear. The points and the origination fee for the loan, interest, lender's title insurance, and property taxes. Those things are not, do not qualify as being fees that we can deduct out of the sales price. So we stick with the non-recurring. So with that example, we see 100K was the non-recurring. So now they need to buy equal or greater to the 100K. So the 100K, what that means is that all the cash that comes out of the property needs to be used, and any loans that are paid off must be replaced with new loans or cash. So if a replacement property is only 800K, then taxes will apply to 300. That's the amount that's not replaced. This would be considered a partial exchange. So if we sold for 1.1 and they only buy for 800K, they have a $300,000 difference. Then what happens is that exchange is great, but it's called a partial exchange, and they will pay taxes on that difference. Okay, so if all the proceeds, if they bought equal or greater, all the bottom line is all proceeds must be used in the replacement property. So that way they would have a totally deferred exchange. But this is good to know that sometimes they buy equal or greater to what they sell for, but they get a loan that's higher where there's money left over. Even though they bought equal or greater, because there's money left over, that money will be taxed. So there's two different types of taxable events, something called cash boot. So any money left over, that money that's left over is called, that money that's left over is called boot, and they will pay taxes on that difference. Or there's something called a debt boot. I'm sorry, my phone's ringing. Let me put it over here. Let me make that noise go away. Thank you. So something called debt boot, which is in the sale of this property, let's say the 1.1, say they had a $500,000 loan on that. Now, some people think that because that loan was paid off, that it's gone. They don't have to worry about it. But when it comes to deferring the taxes, doing a 1031 exchange, it isn't gone. So what IRS requires is whatever loan is paid off at the time of closing, that loan needs to be replaced with whatever they buy with a new loan or bring in new cash to offset that loan. So if I had a $500,000 loan debt and I had money and I could, whatever I'm buying, I can bring in that $500,000 to escrow on what I'm purchasing, and that new money that I bring in will relieve that loan debt that needs to be replaced. Otherwise, I need to get a new loan equal or greater to the payoff amount of $500K. And that's how you have a totally deferred exchange. So you use the cash that comes out, the proceeds that come out as a down payment, and replace loan debt, it's a loan debt, with a new loan equal or greater to what was sold. Okay, so we talked about our time frame. So let's go back here. Relinquished property. So the taxpayer sells relinquished property at closing, the time clock starts, and they have two different clocks that start. Replacement property, they have their ID period for 45 days to identify what they're going to buy. And of this clock, they get a total of 180 days. So when 45 days are up, they have 135 days left, about 180, excuse me. They have 135 days left, and they have to buy whatever was identified on that ID sheet by the 45th day. Now, what's important to understand is that these are calendar days, not business days, and every day counts. There's no extensions. The 45 days are 180. If it falls on a weekend, that day's counted, or a holiday, that day's counted. So you want to make sure that you manage this transaction. If there's a holiday coming up that is closed and the 180 day is going to be, landing on that holiday, it needs to close before that holiday. Okay, so very important timelines. They're very strict, and this could blow the whole exchange if they didn't close on the before the 180 days. It could blow the whole exchange. Or if the property wasn't identified, whatever they're buying was not identified by the 45th day. Now, there are some exceptions. One is, as we've seen a lot lately in the last few years, presidentially declared disasters. So if there is a disaster, a hurricane, COVID, tornadoes, whatever it may be, flooding, and if there's a declaration that's been issued to that area, then there would be an extension. Active duty military, for military personnel, they get an extension. If there's, they can apply for an extension. The next thing that's really important is if from October 20th, approximately, of every given year, to December 31st, the 180 days will end by April 15th, when they file their tax returns. So the reason why I bring this up is somebody files their tax returns and their exchange is not done, then that finally the tax returns ends the exchange. So what we need to do is, if the client needs 180 days and the tax April 15th is going to fall in there, then the client needs to file for an extension on their tax returns, finish their exchange. The extension doesn't give them any more time. They just need to finish their exchange and then file the tax returns. But we work very closely with our clients, so we also help them to remind them that they have to get their exchange done before their tax returns are filed. Now, we did talk a little bit about the 45 days and the ID period. So now, well, just as a real quick review, planning is the key. That we need to really start planning before you even list what they're selling. They need to figure out if they're going to do an exchange. They need to talk to their CPA, their accommodator, whatever they need, so that they can have a plan so they can move forward. When the property goes into escrow for the sale property, then as I stated, that's a perfect time to start looking for replacement properties, presenting offers, getting them accepted, and getting due diligence done so that whatever you do identify is going to be more of a fact than a hope. And maybe negotiate a little longer escrow, like we talked about, 30, 45, 60, whatever you can. CAR has a form that is buyers and seller intent to exchange supplement. And this form also is a great way of pre-negotiating an extension to the close of escrow if need be. Okay, so now, if your client's doing an exchange, there is language that really needs to be put into the contract. So this is our language here. It says buyer, seller, because it goes for either side, acknowledges that it's the intent of the whatever seller buyer to effect a 1031 exchange. If sellers or buyers' rights and obligation under this agreement are assigned to the accommodator, exchange resources in this instance, for the purpose of completing a 1031 exchange. The buyer and seller agree to cooperate at no additional cost or liability, and with the seller and buyer and exchange resources in a manner necessary to complete the exchange. This verbiage is real important. It helps relieve any stress because sometimes a buyer thinks, if my seller is doing an exchange, how is this going to affect me? So this verbiage basically shows that they're not going to be affected. They're, they just need to understand that this process is going on. Okay. So now, when it comes to identifying the property, there are a couple rules that may apply to the taxpayer. So they need to figure out which was the right one for them. So let's talk about that. Martin Lee wanted to know, can they claim the purchased property as an investment for 1031 purpose, but live there? Martin, no. They need to, their intent, remember we talked about intent, must be that they use this property for investment purposes, thus renting it out. They need to rent it out for 2 years before they can successfully move into that property, or IRS would disqualify their exchange. Okay, so there's 2 ways of identifying a property. So let's talk about that. The first rule is the most common one. It's called the 3 property rule, where the taxpayer can identify up to 3 properties without having to do any additional math. You just need to, if they're going to buy 1 property, as long as they have properties on there that are equal or greater to what they sold for, they can defer all their capital gains event. But if they do identify 3 and they only want to buy 1, they're not required to buy all 3. They're just required to buy something on that list. The other rule is called the 200% rule. Now, this is a little different. This is the example that we talked about where if the taxpayer has a larger property that they're selling and maybe wants to buy smaller properties, they can do that and they want to buy more than 3. Then this 200% rule is the way that they can do this, accomplish that. So what they would do is say they sold for $2 million. Now they double it, hence the 200%. So now they have $4 million. They can identify as many properties as they can, but each property they identify must have a value. So you can see on the identification sheet, they put a value, the property address, and then they would sign. So now they can't, in all the properties identified, they put their value and you add everything up towards the bottom of this form, you cannot exceed that double value, that 200%. So it could be my 200 value in my example is 4 million. It could be 3.99 or 3.8, whatever it may be. It could be short, but it cannot exceed. If it does, there's an exception to that rule. And it's that they would have to, for this to successfully qualify for the exchange, they'd have to buy 95% of the total value of what they identified. So in English, they basically have to buy everything they identified and close on it for it to qualify. So they identified 6 properties and they went over. So we said 4 million, they went by over like 4.5 million. Then they have to close on everything for that exchange not to be disqualified. So a good example of this is what you see here. They've got 4 properties. They give they sold for 5.5 or 550,000. You double that, you have 1.1 million. So they found 4 properties, each of them the value, they all added up to the 1.1. They were able to close on everything. That's a beautiful use of this 200% rule. Okay, so let's make sure, let's see. Oh, you're welcome, Martin. Okay, so remember we talked about the same taxpayer selling must be the same taxpayer buying. So some example here is John Smith. John Smith is the seller. John Smith is the buyer. John Smith is in a trust. John Smith can buy in the trust or just as John Smith because the trust is set up under his social security number, which is his tax ID number, basically. So it still qualifies, either John in the trust or John out in the trust. And then as we talked about, there's single member LLCs, which is IRS refers to this as a disregarded entity. And so the taxpayer, this disregarded entity or a single member LLC is set up under the taxpayer's social security number and is filed through their tax returns. So in this single member LLC, they're the same taxpayer in it and the same taxpayer out of it. So they can buy in the LLC as a single disregarded single member LLC, or they can buy as an individual. They're still the same taxpayer. And LLC, a limited partnership or corporation, they have to buy in the same LLC, limited partnership or corporation. However it's owned must be, however it's owned, it must be how they buy. I'm going to go through some of these. Okay, so now one of the questions earlier was, what's the next step? Like, what do we do if the client needs to do an exchange? So this is the next step. Once escrow is opened, once escrow is opened, then that's the time. Before that, we want to use that time to answer your client's questions and help them understand what they need to do with this 1031. So now we officially get involved in the transaction once escrow is open. So at that point, you would either call us or email us because we would need the following information. We need the property address, whoever's on title, want the seller's contact information, their cell phone, their email address, the escrow contact information, escrow company, escrow officer, escrow number, and the close of escrow date. Once we receive that information, we'll contact escrow and we request the documents we need to set up the exchange, which are the following: the purchase agreement, the escrow instructions, and the pre-money. And then once we receive that information, then we open the exchange, we prepare an exchange agreement, and then we get everything signed by the taxpayers. We usually use DocuSign. And once we go through that process, the exchange is open. The exchange must be open absolutely unequivocally before escrow closes. So I get phone calls a lot that escrow closed last week, 2 weeks ago, a week ago, whatever it may be, and they want to open up their exchange. Unfortunately, it's too late. Escrow has to be open. The exchange needs to be set up before that closing takes place. Okay, here we go. Now, when the properties that they're buying, once they find the replacement property and we have the exchange set up because they're in escrow on what they're selling, then we will need the following. First of all, we need you to somebody needs to contact us because we need to get the escrow information for that replacement property, who the company is, the escrow officer. Sorry, I got all these phone calls popping up. Escrow officer, so that we can request those documents that we need, being again the RPA, the escrow instructions, and the preliminary title report. So once we receive all that, then we're able to prepare the exchange agreement. We also need to make sure that there's that cooperation clause that's in the contract where the seller will cooperate with the buyer with the 1031. So before we were doing the buyer would cooperate with the seller, now it's a reverse because this is the replacement property. So then at the close, when the escrow closes on, sorry. When escrow closes on the relinquished property, the sale property, then those proceeds actually come to us and we hold that money in a segregated account so that now when we're working with this replacement property, when escrow is getting ready to close on the replacement property, we will be working very closely with escrow so that we can make sure that they get those required funds in time so that there's no delay in closing. And if there's any additional money that's needed to close, then that money comes directly from the taxpayer and they give it directly to escrow, deposit that money into escrow. If a taxpayer, in going through finding the replacement property, they fronted the earnest money deposit, they paid it, then at the closing of the purchase, that earnest money deposit could be reimbursed at closing to that taxpayer. Okay, let's make sure there's no other questions. So one more thing I wanted to talk about was when the exchange funds can be returned. If somebody cancels their exchange and they did not identify properties, then they'd have to wait for day 46 to pass, and the monies can be refunded back to them. They cannot wait. We cannot return those proceeds before the identification period has passed. So with day 46 on, we can return that money. If all the identified properties have been acquired, and it's after the 45 days, if there's any monies left over, the money can be returned to the taxpayer. The next thing is if they proceeded forward and the exchange were past 45 days and they identified more properties than what they bought, and now the things fell apart because they identified more properties than what they were able to buy, then we're unable to return those proceeds until the 181st day has passed. Okay, and then of course, as we talked earlier, then the withholding for the state of California will come into effect because there was not a successful exchange. So that money, the 3 1/3 would be withheld and that'd be paid to the state of California. Okay, so at this point, I'm just going to open it up to any additional questions. Does anybody have any additional questions that they may have? The question is, does your company handle 1031 exchanges for selling an out-of-state, like Massachusetts, MA, property and buying one in California? So Betty, the answer to that is absolutely. We're a national company, so we work all over the US. And most of our exchangers these days will sell like in California or sell in another state like New York and buy somewhere else. So they're looking for the best investment all over the US. And so absolutely, we can handle whatever exchanges are, wherever the properties are, they can exchange anywhere in the US and we are absolutely qualified to handle that. And we have offices all over the United States, so that helps too. I'm glad, thank you, Sarah. And yes, this information will be available, PDF to be emailed out. So what I need is, please email, I'm going to put my email address in here. So email to us that you want the PDF for the PowerPoint, and then we can send it out. I'm trying to look at this real quick. I don't know how to...
I can email it out to the attendees, Debbie.
Oh, thank you so much. Okay, perfect.
Follow-up email with the recording to everyone, so you will all get via email, I would say by Thursday.
Perfect. Okay, let's see, just more questions in the chat. Perfect. Anybody have any other questions? We're ending a little early. I really appreciate everybody's patience with me, and I appreciate being able to share this information with everybody. And if you have any questions, feel free to call. Like I said, we have my partner Frank and myself. We both are very we both take it very seriously so that we can help your potential clients and your clients so that they can make right decisions. So we want to make sure that everybody's helped. So don't hesitate calling or emailing us so that we can answer. We're happy to answer whatever questions you have. Okay, let's see. Yes. And May 21st, we're going to have the same class in the Fountain Valley office for OC Realtors. So please sign up. And let me check and see if there's any more questions. And it was my pleasure to be able to be with you guys today. Anything else? Okay, so Elsie also posted in the chat the registration information for the class on the 21st of May. So is there any other questions? Okay, so you have our contact information here. So please feel free to, you can scan it and save it in your phone that way, or you can write it down. This is our contact information for Frank and myself. Yes, Margaret, the class on May 21st will be a live class at the Fountain Valley OC Realtors office. So we'll not be on Zoom. Okay. I'm thinking we're pretty much. Okay, so, oh, looks like there might be another. You're welcome. It was my pleasure. If there's no other questions, I think we'll conclude the class for now. Oh, how do we pay for your, two questions. How do we pay for your service? Our fee is taken out. It's a flat fee of $1,250 for one sale and one purchase. And it's taken out at the close of the relinquished property, the sell escrow. And so the client does not have to come up with any extra cash. It's an allowable use of their exchange of their proceeds. And it's part of that non-recurring closing cost that we talked about. Okay, I think we might have done it. Have a good day, everybody. Have a great rest of your day. It was a pleasure being with you all.